I want to welcome everybody to our today housing market town hall webinar. I thought this would be a great segment to talk about the current and future trends of the new homes, because we're starting to see it and hear a lot of people getting their new homes contract canceled. And the new home builders obviously have different strategies nowadays. Let's start with some introduction of our today's speaker. He is the founder and the president of the Gregory Group, a real estate information and consulting firm. And as an expert in residential real estate and land development, Greg has been through 4 real estate boom bust cycles and is considered a leading voice on future trends, home design, real estate economics, and demographics, and buyer segmentation. I kind of smile about this is because I think because we haven't been in a recession for so long, and for some of us who've been in the industry for a long time now, we kept saying like, oh, this is nothing compared to the last recession or compared to the ones in the 80s. So I'm really interested to hear what you're going to say later on about this particular recession.
Well, we're not in a recession yet.
Not yet. Exactly. Yeah. And that's actually, that will be another discussion too, whether we are in a recession or not already, and whether our housing market is going to crash or not because of this so-and-so called recession. So yeah, we're going to have a lot to share. But first of all, if you're on this channel right now, you probably have subscribed to our channel already. If you're not, please do subscribe. We constantly providing you with a lot of data every single month with the most up-to-date information about the market. We are very local, specifically about the Bay Area housing market, but we also want to share with you some of these real estate education. For example, last month we had talked about the pros and cons of Delaware Statutory Trust as an alternative 1031 exchange vehicle. And we had many different topics. So feel free to go onto our YouTube channel and check those out. And of course, if you are on social media, feel free to follow us on Facebook, LinkedIn, and Instagram. So I think this is a good segue to come to you now and then ask you what you think, because obviously you give a lot of these home builders your advice and your data as well.
I'm at the Gregory Group. We do 2 things primarily. We have an information side of the company where we survey new home projects throughout Northern California. We do that on a quarterly basis. So our most recent quarter was the second quarter of this year. So ending in end of June. So we've missed a little bit of the July and August numbers, although I have some input on that. And then the other half of the business is where we do consulting. We work with home builders and banks and all of those folks in putting together feasibility and just general economic and demographic and so forth studies. So what we wanted to do is sort of give a top line view of what we're seeing in the Bay Area in terms of the new housing market. And you know, I know that the Bay Area is typically considered to be the 9-county area. We survey 7 of those counties. We don't survey the city of San Francisco or Marin County, but everything else we do. And so it's sort of all of those together. So you know, it includes Napa and Contra Costa and so forth. So you're going to see numbers that are reflect all of that information. So anyway, the first thing that I think, you know, Helen talked about this a little bit, but you know, we have a graph here of Freddie Mac's 30-year mortgage rates going back to when they first started back in the 70s, so 50 years. And you know, we were all been pretty. We benefited a lot from, you know, in the 80s when interest rates declined, you know, and they've been historically low for some period of time until very recently. And in fact, in December of 2020, you know, the end of the first year of calendar year of the pandemic, we saw interest rates down to 2.68%. Which if you had $1 million home with 20% down, 30-year mortgage, 1.06% tax rate, your payment would be about $4,100. Pretty good rate for $1 million home, $800,000 mortgage. However, over the next you know, year and a half, those the interest rates have actually increased. And this is the way that we take this number is it's an average of the month. And so in July, that average was 5.41%, almost 5.5%. You do the same calculation, you get a mortgage rate that's about 5,300. That's 31% increase. the thing to notice about that, or sort of be aware of, is that, it's $1,200 extra in payment, which is quite significant. Requires about a $40,000 to $50,000 more in income during that time. Now, incomes have been increasing as a result of inflation in a tight labor market, but not 31% over the last 18 and a half months. So the price of housing, the cost of housing related to mortgages and so forth has certainly increased. We would say as well that what we found is that there seems to be an inflection point around 6%, because there was a month where the interest rate did get to 6%. And when we saw that occur, we really saw an abrupt slowdown in activity. And that includes traffic and down payments and deposits and so forth on new home projects. So the good news is it seems to be moderating at this point, especially as inflation comes down. But it's still an unknown. I mean, if I could predict mortgage rates in the next 2 years, I'd certainly be in somewhere like Vegas instead of Sacramento. And it's just very difficult to do, to know what the Fed's going to do and so forth. But anyway, it has clearly increased the cost of housing. And, it's interesting too, because, and when you talk about a $3 million house, it may not affect it quite as much. There may be a greater impact from the stock market decline and people taking money out for that purpose. But when you get in the $1 million range, you start to have a more direct effect. People tend to be a little bit more price sensitive on the cost of housing. What is the cost of housing? Well, if you take all 7 of those market areas and you do an average, you see we're about 1.14 million for that, an average of all those homes. That's up about 10% year over year. So, second quarter through second quarter, you can see the changes there over time and so forth. That's the highest it's been in 20 years. But we think that's going to be the height of the market, and we think it's going to start to moderate off of that. It's price decreases in the second quarter was 20%. The year before it was 0. And no price changes is at 52%. That was very low last quarter or a year ago. And really the main thing we saw were price increases. And you can see that on the graph is the last year. And the number of incentives, the value of incentives, it's base price, and then the builders will offer incentives, has increased about 56%. That's a pretty moderate number at this point. I would suggest that in July and August, that number has increased. I'm not convinced that price decreases. Actual base prices have decreased significantly. But I think incentives have gone up, and a number that people can use towards options or upgrades or premiums and so forth. And sales have certainly slowed, and I'll show that in a second. But it's interesting to keep in mind that in the home building world, due to a number of factors, a great volume of sales, but also the supply chain issues was really a huge impact on the home building industry. I've driven by projects that was essentially complete except for a garage door, and you saw just plywood up, and the house not being finished, and builders trying to get people to close with no garage door and saying it'll come. And so those type of things really slow things down. Those are starting to be alleviated in some degree. And there's a significant backload that builders have throughout California and really throughout the nation. And so I think that we're going to see builders really concentrate on getting those homes closed through the rest of this year, and be a little less concerned on the sales side. And in view of that, I think that you're not going to see huge base price decreases, because one of the things that happens is then people that are in escrow come in and say, hey, look, you just decreased prices $50,000. I'd like to have $50,000 off my house. And so I think they're going to want to try to stay away from that. So I think the pricing, I do think it'll moderate and it'll start to come down in the third and fourth quarter, but I'm not sure it's going to be as significant as people think. I would also note that at the end of the year, I think the price appreciation will be positive. Depending on where you are and what market, we've seen prices go up significantly, 30, 40, even 50%. And if a price comes down 10% or even 15%, I think that most buyers are still pretty happy with that over a period of time. So sales have actually is the one that's hit the wall pretty significantly. Year to date, sales are down 44%, a pretty significant impact. We think at the end of the year, they'll be down 30 to 40% in the Bay Area, potentially more depending on how it goes. But you can see the drop off. It sort of started about a year ago. And if you look at the trend, the 4-quarter trend, part of that is due to pricing and increasing interest rates over a period of time. But really a lot of it's due to increasing inventory as well. And this slide here shows the increase in, decrease in inventory over that period of time. I misspoke. So you can see that, at the beginning of the pandemic, inventory really decreased significantly, going down to near all-time lows in the second quarter of 2021. And a pretty steep decline as builders slowed down the release, and it became harder due to supply chains and all those things to finish homes. So they were holding off projects or holding off homes entering the market longer as prices increased and so forth and so on. But we do see even in the second quarter, we do see an almost 100% increase in inventory. And we do think that's going to continue at a pretty substantial rate over time as we move forward. And so we'll see those as the next quarters come out. And so, a lot of what we look at is certainly pricing and sales and inventory, but we also want to consider what drives the market. And it's really, really fascinating in California as a whole, in the Bay Area, certainly, as a segment or region of that. And so one of the things that we looked at is, and I sort of alluded to this earlier, is this whole aging of the population. And the California Department of Finance makes projections. And I would just say that I think these numbers will probably change a little bit. Pandemic has thrown a wrench into some of how it's calculated and what's happened and so forth. But I think that it's in the July 22 numbers aren't out yet. So I think that while they may change somewhat, I think the overall trend of what's happening is real. And I think we can all see that as we move around town and so forth. But really, the fascinating thing is that over 65. So what we've done is taking age cohorts by population by age for all 9 counties, and then we said, well, how does that? And then taking the projections of the Department of Finance and what is that difference? And when we look at that, we see, for example, that under 24 is actually declining. It doesn't mean there's no one under 24 years of age. It just means the number of those folks is going to be declining over time, the next 10 years. And clearly we know the population's aging. And we see the 25 to 34 where the millennial generation and the Gen Z population is increasing. But 65 and over really makes up only 23% of the total population, but it makes up 99% of the population growth. That the baby boom population is huge, and it's clearly aging. So how does all of this fit into what we think is going to happen in housing? Well, clearly, we see a opportunity for older for housing that addresses folks in the baby boom generation. And that's a whole variety of things, really. That's active adult, age-restricted housing, things like Sun City, that Sarah Shea is doing some trilogies, those type of things. It also includes things like assisted living, memory care, independent living. Certainly, as the age over 75 population increases, that becomes a bigger factor. A lot of people, keep in mind, want to age in place. And even though their homes may be 30, 40, 50 years old, there's this segment of rehabbing homes, that's going to be pretty popular going forward for some of these folks as well. And then, lastly, a lot of these folks are leaving. They're moving to either where their kids are, and that could be, Brentwood, it could be Sacramento, or in a lot of cases these days, it's out of state completely in the communities like Arizona and Nevada or Texas or Florida and so on, for a variety of reasons. Following kids tends to be a big one, and the kids can't afford California in large measure. So we just see this huge older population. And then on the other side, especially in the Bay Area, it's going to be really focused on affordable housing, more obtainable housing, a lot of high density attached, high density detached, in that $1 to $2 million range, let's just say. People have a good job at Apple or Facebook or whatever, and can afford that type of house. Where it gets more dicey is in the middle ranges with growing families. That product becomes very expensive. A lot of those folks are moving to outlying areas. We see a big influx in areas like Lathrop and Tracy and Stockton and Nantica, and certainly Sacramento region overall. So this is really something to watch as we move forward. I mean, it's really becoming a significant factor. And then, also this whole part of people leaving the state. And so what we looked at was from in July of 20 and in July of 21, and made the comparisons to, again, the 22 numbers aren't out yet. And, it just turns out that people actually are leaving the state. And leaving the Bay Area in particular. So if you look at, there's two segments to it: natural increase, which is births over deaths. And that's still positive, although it's declining. And I wouldn't be surprised as we move into the future, as that last slide illustrated, that more people will, the number of deaths will exceed the number of births at some point in the future. But really the migration trends are the ones that are most impactful. And if you break that out into a net foreign immigration, we see that that's still a positive number. So there's more people from other countries coming to California and the Bay Area. But the net domestic migration is very negative. And that translates to a big number of overall net change of people leaving. So more people are domestically, there's still people coming to the state, believe it or not, but there's more people that are leaving to other states. And again, that's, tends to be areas like Arizona and Texas. And, it was Boise and Salt Lake City and Nashville, and those areas have slowed as pricing is moderated there. And Florida, certainly. And so overall, what we're seeing is that there are more people, net change in the bottom left slide, that people are leaving the Bay Area in greater numbers. So the population's declining. It's also hollowing out. It tends to be more middle income folks, middle-aged folks that are leaving than certainly a lot of older folks are as well. And younger folks do as well too. But as you saw earlier, there's a greater increase in those populations than there is a decrease. And so I think that's worrisome, in terms of affordability, the very rich people, and then the folks that are at the median or a little bit above in the income, that can't support California and the way of life that we've all become accustomed to. So part of that is there more opportunities for affordable and obtainable housing. We're seeing a little bit more of that in Central Valley communities. And I think we'll still see more of that as time goes on. But that's a big factor. It's clearly the migration trends are a big factor in housing, and Bay Area is affected by it. So just, in the future, what are we seeing? Well, builder confidence, yeah, it's declining. Ellen alluded to this, but it's not dead. I think that people are builders are sort of taking a wait and see approach at this point. Let's get through our backlog and our closings. Let's see where the economy is in January, and then we'll make some decisions about whether we need to have layoffs or how we want to proceed at that point, or delay projects, whatever it is. Land deals, we're still seeing land deals occur. We're seeing them being considered, certainly much more cautiously. The amount of time, their feasibility periods, the negotiations on land values and terms are certainly up for grabs, but builders aren't laying off their land divisions, and they have enough land for next year generally, but they want to be prepared for years after that as well. So they're moving forward. Material and labor costs, we're seeing some material costs, lumber's come down off the highs, but we're really not seeing any relief in cost to build a house at this point, which is interesting. I think partly because there's this backload, and builders want to make sure they get through that. And in order to do that, they need all their subs working at full speed. I don't think we're going to know anything on that until, again, until next year, how that relates to the economy and so forth. And then demographics, we call it first time, last time, or first time buyers and last time buyers. I think that's going to be a huge opportunity throughout all areas in California, frankly. We're seeing a lot of active adult projects in Sacramento and then certainly Central Valley and North Central Valley as well. Didn't talk about work from home or work from anywhere, and who really knows at this point. It seems to fluctuate. Companies want their workers back. Workers don't want to go back. There seems to be a war. It's becoming a little bit more hostile. There's this new trend called, what's it called? Oh, I forget the name, where people are just not working as hard. There's a term for it. It slips my mind. They're still working, but not as hard. And so there's this whole where we work, when we work, all of the stuff is up for grabs, I think. And I don't think we're close, frankly, to settling that. But we are seeing supply and demand rebalancing. I'm not a big guy that says, well, inventory, because we don't have any inventory, there's going to be, we're not going to have any sort of crash or anything. If pricing of homes is too expensive, it doesn't matter how much inventory there is, little or a lot, people aren't going to buy houses. It just doesn't matter. And so if interest rates are ticking up, if pricing doesn't moderate, it's not going to matter, frankly, if there's no inventory or if there's a lot of inventory. So I think it's more involved than just an inventory question. But we do see supply and demand starting to balance, and I think that's a positive thing. So with that, I'll certainly answer any questions, but that's it. Let me get out of this.
That's awesome. Greg, I think I have a lot of questions already regarding the net migration that you mentioned just now. Do you think that because, during the last 2-3 years, because of COVID, a lot of countries were shut down, and that had affected the migration from foreign countries?
Well, yeah, absolutely. I think it's that, but I also think it was political. There were some policies in place that discouraged immigration from overseas, whether it was workers in Silicon Valley. I think those have been ratcheted back. Certainly on our borders, we haven't had as much crossing in terms of helping out in construction and in some of those areas that it's always been very positive influences. So I don't know. I don't have an answer whether that will increase in the future or not. I would think so. I mean, it would make sense to. We have to in one sense, because there just isn't enough internal population growth in the area. And so the only way to really get there is through growth from outside.
Because one of the main reasons I asked this question is because in the past, we had so many clients. I'm talking more than half of our clientele will require some sort of work visa to work here.
Right.
But we really have seen a drastic drop recently in the last 2-3 years. So that make me really feel like, well, we have this huge drop of foreign immigration in the last 2-3 years. And I'm hoping, just like what you're saying, and I think we need it, is that in the next few years we're going to start increasing them back. And I just came back from Asia for family vacation. Hong Kong being such a free city financially, but then of course they're under the China's right now. They were still under this 7 days quarantine period until just 2 weeks ago. 2 weeks ago, they just dropped it down to 3 days. So they are still requiring people who going in and out of Hong Kong to have the quarantine period. And not to mention in China, every city you go to, you still have to be quarantined. So it is definitely, that's one of the example how that has affected a lot of people coming to the United States, because obviously the Chinese investors were one of the largest percentage of the foreign investors.
Yeah, I think it's interesting too, though, and I don't know how this plays into it, but the whole work from home or work from anywhere thing. I mean, maybe that means that not as many people from out of the country will move to the States because they don't have to, or maybe they'll move somewhere else and that's maybe more accommodating than California, or if possible, I don't know. And so I think there's opportunities And I just don't think we know that yet. I just think it's played out, but I think the fundamental point is absolutely right. And that, the only way the population is going to grow in California is through some sort of probably foreign immigration. It doesn't seem like domestically people are wanting to move from, Texas to California. Now, some do, for various reasons, but overall, it's just too pricey, and it just doesn't. Housing is certainly pricey, but gas is still $5.50, and everything else, utilities and all that sort of stuff is expensive. Food's expensive, so it's not cheap to live in the state anyway. And if other states have opportunities that are, similar, maybe weather's not as good and some of that sort of stuff, but I think it's going to be a challenge, and I'm just hopeful that, politically, we don't get too far behind the curve in California, that it becomes a point of no return.
I absolutely agree with you. And one of the common feedback from other countries, especially in Asia, since that's where I'm from, and I still have a lot of families back in Hong Kong, is that to them, over here in Silicon Valley or in California, is very affordable. You actually own a piece of land here. Over there, you only own a tiny little piece of apartment unit, right? So that's why within United States domestically, we are one of the most expensive. But then if you look outside the country, going back to Asia, they look into here, they feel like, wow, I get the land, I get the weather, I get these, employment. It's very attractive. And I do know that a lot of parents over there would much rather send their kids over here for school and hoping that they would get a job with one of the biggest technology companies over here.
Right.
So that would be really interesting to see how that the foreign immigration, whether it will increase or not in the next few years. And when you said that builder confidence, they're declining, not dead. So I believe that you work with a lot of new home builders, and we actually have noticed during the market when it was really, really hot, home builders, they were really tough on the consumers. They're really tough on the buyers. Literally, it felt like we are doing this auction, almost like you're going to a market and hopefully you can grab one of these units, doesn't matter the location. But now they're working really hard trying to find buyers and then giving away all kinds of incentives. Are you seeing that as well?
Oh yeah, funny how that works, isn't it?
Yes, it just completely turned over. I mean, I felt so bad for our buyers before. We had to go to the builder office every single day, and there were hundreds of people there.
And then you mention it to the builders and they go, what are you talking about? The memories are short. But, I mean, yes, absolutely. I think that, again, our information is the 1st of July. And so in July and August, what we've been seeing in our consulting work, and certainly with our conversations with builders, is that it's the incentives are ratcheting up pretty significantly. And they're being used for a variety of things. Their buy downs are big, to get the interest rates down for 3 to 5 years or whatever it is. And then also for options and upgrades, because not all of that is a direct cost. It's sometimes, if you put $50,000 for upgrades, it may only cost the builder $30,000 or $25,000. So there's some advantages there. And then, there are some that you can use it towards, certainly closing costs, but then towards the price of the house. But we're not seeing a ton of that, as I mentioned earlier, because I really think that they're afraid of having to go back and renegotiate actual contracts with with the clients today. And most of those clients, as you had mentioned earlier, the cancellation rates are certainly increasing, but they're not soaring necessarily. They're not going through the roof. Some of the people that are locked in are wanting to close on their homes. And so I think that will continue. And I think that will continue. I just think there's going to be a big push to finish those homes by the end of the year. And I don't think there's going to be as much emphasis on selling existing stuff. We'll see. I don't think they're going to abandon it, certainly, but I just think that it's a little bit more concentrated on their energies.
It seems like it will be a tough position as a home builders right now, considering the market is coming down, the demand is lower because of the interest rate, and at the same time, their construction cost has gone up quite a bit.
Yeah. They're in a squeeze, because they're already locked in on their land, and they're pretty much locked in on their construction costs if they're building now. and sometimes materials, if they haven't locked those in, are increasing as well. Although we do see supply chain constraints easing, which is a big factor in all of this. But yeah, so there, but remember too, when the builders bought the land and when they put their pro formas in place, if they're selling now and they're closing now, it may have been 2 years ago or even 3 years ago when they did that. And so pricing may have gone up, like I mentioned, 30, 40, 50%. And so if they have to go back 10% or 20%, I don't, as long as they don't lose all their current buyers and so forth, I don't really think that that's going to be a huge hit, overall. It certainly will impact them because the price, like you said, costs have gone up. And they certainly don't want to do it from a business standpoint. But, in a market of what we're dealing with, I think that's, not the worst case scenario in the world. And by the way, we're not seeing the significant increases in foreclosures or short sales at this point. Everybody has a job, as you'd mentioned, and so there's no sense of this is anything like 2008 from anybody in the fundamentals. And there's nothing that we're not seeing. Last time no one could see what we weren't seeing. We didn't even know what we weren't seeing. There doesn't seem to be that this time. Now, who knows? But ultimately, but that doesn't seem to be the case here. It just seems to look. I mean, I think that the Fed is trying to tackle inflation. They're being aggressive on interest rates. The rest of the economy is actually doing, I think, very well. Good, okay, however you want to classify it. But the brunt of interest rate increases tends to be those industries that are interest rate sensitive. And what's the number one? Well, housing. So
exactly.
So, I could see the Fed sitting behind closed doors saying, okay, well, look, we'll raise interest rates and we'll get inflation down and under control. They may hit a little bit of the stock market, but, that's gone up for 10 years straight. And home pricing has gone up 50%. And so, if it comes down 15%, okay, but we're not going to, politically, that's not a bad thing for us. People still have jobs. Yeah, maybe it'll tick up a little bit, but so, right now it seems to be going according to plan. We'll see if it continues that way, but
Well, so let me ask you this then.
Yeah.
This is a tough question. How much longer do you think this slump is going to last? And do you think the housing prices is going to keep dropping for the next 12 months, or you think it's going to be something by next year? Early next year is going to bounce back up?
Yeah, I think pricing was certainly going to continue to moderate this year. I don't think there's any question about that. And then I think it will depend. There's about a 50-50 chance, I think, and I think a lot of people would say this, of a recession, a true recession in first or second quarter of next year, depending on the results of the Fed, how the Fed maneuvers this and so forth and so on. I don't think we're in a recession by any stretch of the imagination today. Now, maybe people could say we're in a housing recession because it's fallen pretty significantly in a lot of sectors, a lot of areas. But I don't think we are in the overall economy. We may hit it, next year, and if we do, then I think, I think that we'll continue to see moderating pricing and sales for next year. We're actually projecting a price decrease next year in a lot of markets, not significantly, but a little bit. It won't happen this year just because of the way the numbers are stacking up. And so that we think that's potential. But look, consumers now, the buyers and the agents and so forth that we talk to are saying, look, the buyers are, they're not necessarily eager to go out and buy a house if, they think the price is going to go down $20,000 and in 6 months, or they don't have to move, and those that do are,
Right.
they're doing what they have to do. But if you're buying a house and maybe 70% of home owners in the state of California have a mortgage rate that's under 4%. 90% have one that's under 5%. I think that's roughly the numbers. If you don't have to move, like you've been transferred or your house is falling apart or whatever, why would you go anywhere if you have a 3.5% mortgage rate and you'd have to pay 5.5% today and spend more money for the house? So those are questions that buyers are asking themselves, and they're saying, well, maybe we'll let this play out a little bit longer. And I think that's happening.
Yeah, I think I mean, I keep going back to how this internet has like two sides of the debate right now. One side's like, oh, housing market is going to crash big time. It's going to be really bad. And the other side's like, no, it's more kind of like, yeah, our economy is doing pretty well. We're not going to see this big housing crash. And if any of the realtors say, hey, look, this is nothing, it's going to be okay, then they can say, of course, you guys are salespeople, you're going to say that it's fine. So that's why I've been trying to avoid that, that what I think that the house market is going to do. However, one side of the story is that, okay, the housing market is going to crash because we might have a surge of inventory. A lot of these sellers are going to want to come back out and want to sell their properties, and that's when the market's going to crash. But at the same time, we saw that back in 2008, when the inventory was really high, was because so many homes were underwater and they went into foreclosure or short sales. And that numbers, if we look at the foreclosures, even though we have the moratorium lifted now, so the banks can actually start foreclosing, that number is nowhere close to what we had back in 2007, 2008.
Right. I just think that, I mean, if everyone starts putting their house on the market because they want to sell, maybe they're trying to grab the last remnants of this, of this boom here in the pandemic. But, ultimately, they're going to have to make a decision then whether they keep their home on the market or not. And, I think a lot of those folks will probably just take it off the market and say, I don't want to take $50,000 less, I don't have to move, and I can suffer through, I can deal with this for another year or two or whatever. And so I think that's happening. Home building side, it's a little bit different. They have a project, they open it, and they give units available for consumers to buy. But it takes so long for projects to get approved in the state of California that it makes it difficult to see any real surplus of inventory. Certainly over the last 10 years, and we haven't seen that. And so I'm not too worried about that on the new home side. And I'm really not that concerned about it on the other side as well. I just don't think inventory is it's certainly a metric, but I just think the cost of housing and incomes and interest rates and affordability is a gauge to really pay attention to. And employment, I mean, ultimately it going to come down to employment. So
that's a really great point, because again, because the market has slowed down quite a bit. Some of the sellers, like I mentioned earlier, if they are on the market during the summer, that's because they really are very motivated to sell. But then there are also a lot of sellers, they pull it off market because the rental market is still really strong. Right. They can easily just rent it out and then still either break even or cash flow.
Exactly.
So that's actually happens to quite a few of our sellers right now, saying like, hey, we're going to pull back, we're going to rent it out. And they actually rent it out really quickly. Right. And then they're going to come back next year when the market's better.
Yeah, I agree. I think we're seeing that all over California, actually.
Yeah, and then this is really, I think, is a really interesting topic, and I always think that we have clients, buyers who are really concerned about the market. We do feel that, I mean, again, I always think that maybe I am biased. I'm a realtor, but you know what? I'm also an investor. As an investor, I would love to be able to buy all these great deals. I would love the market really come down more, have a crash, so we can go out and invest more. But it's just that when we look at all these different factors, it just doesn't seem like our employment is great. Our, the only thing that I see is that the interest rate has affected so much of people's affordability. And then the stock market, some of the buyers, they are really waiting for the stock market to come back up, and so that they can pay for the down payment. But otherwise, consumer confidence level is not too bad. So yeah, I don't see that the housing market is going to crash like some of the people have said. Maybe I'm just looking at Bay Area. I don't know about any other part of the country. Do you think?
Well, yeah, I mean, look, I was on a plane, I don't know, this was a couple of years ago now, and I heard some guy behind me telling some guy, they were talking about the housing market, and I perked up, so I listened to what they were saying, and one guy goes, yeah, I'm going to wait, because I think we're heading for a crash, and it's going to be like, maybe not as bad as 2008, but it's going to, we're going to crash. And so I'm not going to buy now. And of course, if he bought, he would have had a 50% increase in value of his home. So no one, this whole internet debate to me is just silly. I don't really pay a lot of attention to it at all. If you look at some of the data points and so forth, we're not like I think I would agree with what you just said, but what does that mean for next year? I don't know. I don't think anybody knows. And you got plenty of people that'll tell you what they think is going to happen, even economists. And the economists are wrong. I mean, most of the Fed didn't think there's going to be inflation.
Exactly.
So they're supposed to be the smartest guys in the room, and apparently they're not. So I just think the way I look at it is that you should be prepared. Like if you're an agent or if you're a buyer or a seller, look, if the market recovers and come January, everything goes back to normal, then great. Then you're in a good position, know what to do. If the recession comes in January and it hits, for 2 or 3 quarters, well, okay, then have a plan for that, and be prepared and plan out a strategy. I think that's the best way to move forward at this point, because it's just really, really unknown. It's just people are just up. Everybody has an opinion on where interest rates are going, and there's seems to be no middle ground anywhere. And it's even when you take the averages, the numbers are so disparate that it's just really hard to figure it out. So.
Yeah, and that's funny. You just said that even economists are wrong sometimes, and which is really true. And then even we do those projections, mortgage rate projections by Mortgage Bankers Association, NAR, and Freddie Mac, Fannie Mae, and their projections change on a monthly basis or quarterly basis. So these are created by the smartest people trying to project the mortgage rate as closely as possible, but it fluctuated over 100 basis points from just a few months ago. So at the end of the day, I think people, when you listen to the internet, on the YouTube channel, including ours, look at the data mostly, and don't be so affected. We have buyers that emotionally really affected by these news, and your neighbors, your friends are all telling you like, this is such a bad time, don't buy right now. The time is yours. If this is the right time for you, and it is. I agree with like maybe investors, home flippers, and builder could be a little concerning because they have to figure out the cost, and then so that they don't lose money. But if this is for you yourself to live in, you're planning for long term. This is not a short term investment.
Right. People ask me quite occasionally, should I buy a house now or not? Just friends or whatever. And I always say, well, what's your goal? What's your objective? Are you going to live in it for 20 years, or are you going to live in it for 2 years? And you can provide an answer based on that. If it's 20 years, yeah, go buy it. I mean,
exactly.
You can refinance when interest rates go down again, and you can afford it and everything. But if it's 2 years, well, you probably want to be a little bit more cautious. Maybe it's time. If you have to go, maybe it's not. I don't know. But you can pan it out or pencil it out, or whatever scenario works for you.
Absolutely. I really appreciate you, Greg, for sharing so much information with us, and then letting us know what your thoughts about this market. I hope that our audience got a lot of great information. The most important thing is that we are sharing statistics with you just so that you can make the right decision for your own investments, or if you're an agent, use those information to advise your clients. So, well, hopefully I can see you guys next month, and don't forget to subscribe.